Welcome back to the Longacres Finance channel. Would you like to invest in a great business that is down 26% this year, has a long history of double-digit dividend growth, is projected to keep growing in the future, and historically has crushed average market returns? Then join me to find out why I am currently adding to my position in Home Depot. Home Depot is the largest home improvement retailer that only keeps getting bigger. The company released their Q4 and fiscal 2021 earnings earlier this year and reported a record sales figure of $150 billion. In fiscal 2020, sales were $132 billion and $110 billion the year before. That's a tremendous expansion of $40 billion in additional revenue compared to 2 years ago. On top of this massive increase, management has also improved the operating margin by approximately 1%, from 14.3% 2 years ago to 15.4% in the past year. The operating margin has been slowly improving for the last decade, from about 11% to the current 15 to 16% range. Home Depot has also grown its earnings per share, year over year for the last 10 years. 2022 earnings per share were $15.50, which is a 29% increase over 2021. Investors likely won't see such a large increase next year, as the forecasted growth rate is approximately 3.9%, with the earnings estimated to be $16.1 per share. While I would prefer to see higher growth, I think Home Depot is cautiously projecting the economy to cool off over the next 12 months. Home Depot has a fantastic return on invested capital of 51% in fiscal 2022. This rate is in line with the last few years and an improvement from a decade ago. The return on invested capital can be used to gauge a company's ability to generate money above the cost it pays for its debt and equity. A high return on invested capital is very favorable and implies the business is efficient at creating value for shareholders. Home Depot has actively employed a share buyback program, reducing the number of outstanding shares by nearly $500 million during the last decade. More precisely, outstanding shares have declined by 29.8% during the past 10 years, and currently sit just north of 1 billion shares. Buying back shares is favorable for both investors and the business. For the business, it improves bottom line growth as earnings per share are computed using a smaller number of shares. This also lowers the overall dividend payment the company pays and allows that dividend to increase faster. Investors, on the other hand, can enjoy favorable dividend growth and increased value of their shares as the company continues to grow. Home Depot currently pays a forward dividend of $7.60 per share, based on the recently announced quarterly dividend of $1.90 per share. Last year, shareholders received 4 quarterly dividend payments of $1.65 per share, for a total payment of $6.60. The most recent 15% increase was announced in February of this year, and shareholders will enjoy an extra $1 of dividend income for each share they own in this calendar year. Home Depot has a 13-year streak of dividend growth and a 34-year streak of uninterrupted dividend payments. The company did freeze its dividend during the financial crisis, but continued to pay consistently and resumed increasing the dividend rate shortly after. The most recent dividend hike of 15% is slightly below the 5-year average dividend growth rate of 18%, but still very fast for a mature company with such a long streak of dividend payments. Over the past 20 years, the dividend growth rate was an even more impressive 20%, and it's only natural that we see this rate slow down. I think Home Depot will continue to deliver fast double-digit dividend growth in the next few years. With such a fast dividend growth rate, we would expect to see a rising payout ratio. But Home Depot has actually maintained a healthy payout ratio in the mid to high 40% range, occasionally crossing above 50%. This healthy earnings payout ratio leaves plenty of room for future dividend expansion. Home Depot offers a 2.53% dividend yield right now that looks very attractive to me for the combination of business quality and dividend growth this company offers. The current dividend yield is also more attractive than the 5-year trailing dividend yield of 2.25%, suggesting a potential 12% undervaluation right now. The forward PE ratio sits at 18.7, that is also below the trailing 5-year average PE ratio of 21.3. This also suggests a potential 12% undervaluation. The PE ratio is, however, higher than the consumer discretionary sector as a whole, that has a PE ratio of just 13.1. But quality businesses generally run hotter than their sectors, and a strong business like Home Depot will demand a premium to the market. The share price currently sits at a 52-week low, and to me it looks attractive. The stock is grossly underperforming the S&P this year, with a loss of about 27% versus only 13% for the S&P. But if we zoom out further, even with the recent poor performance, Home Depot outpaces the S&P in terms of total return during the last 5 years, offering a total return of 116% versus only 89% for the S&P. This gap widens if we look at the last decade, with a total return of 620% for Home Depot versus only 258% for the S&P. I think Home Depot will continue to crush the broad market in the long run. The question is, do you have the time and patience to wait? Home Depot is the 16th largest position in my portfolio, but could move higher as I have recently resumed adding capital to the stock. I contributed to my position between January and July of 2021 at various prices in the range of $258 to $327. At the high end of $327 in July of 2021, It just didn't make sense for me to add more capital to this position. The share price continued to climb higher, eventually peaking around $420. While it was nice to watch my position increase in value, it is difficult to continue to invest at such elevated valuations. I resumed investing in the stock in late February of this year, when the share price fell to the low $300 range. I have been adding more each week as the price continues to struggle. My long-term yield on cost is 2.56%, which is still a little more attractive than the current dividend yield. But if the price falls a little more, I'll be able to improve my long-term position. Home Depot is a long-term holding for me that I intend to hold forever, so I am perfectly comfortable dollar cost averaging into the stock now. Let me know if you agree with me that the stock is attractive at its current price and a 2.5% dividend yield. If you enjoyed the video, please give it a like and subscribe to the channel. See you next time.